Paul, welcome back. We're back for another monthly chit chat. That's what I'm going to call it from now on. Just a straight up chit chat about different styles of investing. And I think, what is this? Maybe 5 or 6 we're at now at this point.
You know what, Darren? Just as you introduced me, and hey, Darren, I'm glad glad to be doing this monthly chit chat with you again. I just realized I didn't check and see which month this is. I don't know if we're at 5 or 6 or so. But
I
anyways,
think I think it sits around about 5 or 6 now. And what I
yeah,
find interesting about that leading into this conversation is when we originally started this, I kind of had this idea that our portfolios were similar. They were in size, but
yep.
obviously things have changed since then. Mine has grown quite a bit as far as the amount of money because I can still accumulate right now, where your design portfolio was simply how do I live off of the income? And I think that's where we brought the conversation today. And so I
Yeah.
thought we would follow up a little bit on what we talked about last month because the markets have been pretty crazy, yeah?
Oh yeah, markets are crazy. I know I watched your monthly recap video, and I'm experiencing the same thing where you take a look at your portfolio and you're up $7,000-8,000 or down $7,000-8,000, right? In a matter. Sometimes it's within a day. It's not even over 2 or 3 days, right? So it's been pretty wild. But I think with everything that's going on in the world right now, with the war and everything, it's to be expected. And actually, it provides some opportunities.
Yeah, for sure. I think that was one of the posts that I put up on Blossom was reading all these comments about I'm buying the dip and everything's on sale. It's a red day, and for me, from my lens, it sort of opened this door of that's kind of an interesting perspective because for me right now, every cent that I have every couple of weeks or whenever I get paid and I do that regular investing, it all goes straight into my portfolio. So I don't have any money left over in the end. And I was kind of scratching my head thinking, am I doing something wrong here? Like, what am I missing? Because the truth is, it is on sale. I mean, the prices have dropped, so they're far less. Like in my video, like you mentioned, I was down some days $5,000 or $10,000 on a day, but I actually didn't have any money to invest. But maybe you could talk about what that's like from the lens of an income investor.
Yeah, and I think it depends on what you're buying, right, Darren? Because the broader markets, like maybe the S&P 500, is only down 4 or 5%, and people will say, like that's nothing. That's not even a correction. It's really no big deal, right? But if you look at individual stocks, for example, Microsoft, I think at one point Microsoft was down 18 or 20%. That's a big deal, if you ask me. Like, that's a buying opportunity if that's a company that you believe in, right? If that's something you want to own, then that is much more, to me, appealing than just being down 4 or 5%. So, as an income investor, what I've been doing for the last month and a half or so, and I've made a few videos about it, is with oil skyrocketing, right? I have an energy ETF from Global X called ENCL, and the last time I bought it in January was just over $17. And I was just doing my regular monthly buy. And with everything that happened and oil going over $100, it hit a high of, I think, just over $23. So once it broke about 21.50, I started selling it off 100 shares at a time. And what I did was I put the money into PLTE, which holds Palantir, because Palantir was going in the opposite direction. It dropped like 30%. It was at $28. I think today it was around 16. It might have even broken 16. I think it hit 15 something. But it pays a higher dividend than ENCL does because Palantir is a lot more volatile. So basically what I'm doing is I'm realizing some gains, right? And I'm moving the money into a fund that's on sale and increasing my income all at the same time. So for me, that's like a win-win-win.
Right. So like from the lens of a growth investor, at least me, what I would do is once a year rebalance, and I'd be looking at whatever I have, more of, and then selling that and putting it into something that didn't do as well during the year. but I don't do it throughout the year. So it's interesting to hear that you're doing it, and this is the time. So before we came on, we were chit-chatting, the volatility is obviously very much related to what's going on in Iran, and it's all energy related. So when I had originally asked you off camera that this is something we should talk about, I was surprised to hear that ENCL is actually doing quite well. But do you think that's because of the volatility piece? Because it's my understanding that income funds do better when there's volatility. That's when you get those premiums, people speculating on the price.
Yeah, well, so far, Global X hasn't increased the actual distribution. And I was kind of surprised, right? With the share price shooting up as much as it did, I was hoping they would increase the monthly income, but they didn't. So right now we're just looking at the ETF itself is following. I don't know if you follow any energy stocks, but for example, I remember when Suncor was trading between about $48 and $58. It would kind of swing up and down. Last week it hit $94, right? So if ENCL is holding Suncor and Suncor shooting up to $94, it won't capture all of that upside, but it's going to capture some of it.
Right. No, I actually don't follow them. That's actually an interesting point from my lens. So, um, I am definitely trimming down my portfolio. We kind of were talking a little bit about that, I guess, at the beginning of this year, that our both
Yeah,
of our goals is to trim down our portfolios a bit. Definitely a lot of comments. I do appreciate people's comments when they point things out, the overlap. It's
always.
developed this for me, the spreadsheet. But as far as like uh, the specific stocks themselves, as a broad-based ETF investor, which is the vast majority of my portfolio, I don't really have a need to look at any of them because I own the whole market.
Yeah.
But I can see in the case of some of the funds that you're holding, like for instance, are there any other energy funds like that besides ENCL?
Yeah, Evolve has one called Oily. I'm trying to think if there's any others. There probably are others. Those are the two that I know the best is Oily and ENCL. But it's not just energy ones, even utility funds like Utes from Evolve. Utilities all of a sudden started to do well as people started to rotate out of tech. And I don't know if that necessarily has anything to do with the war in Iran or just the AI tech bubble. Everybody started to worry about the AI tech bubble, pulled some of their profits out of those companies and moved into utilities and energy and more defensive positions. So even those type of ETFs, but they did not go up the way that oil did.
Right. Yeah, that's kind of interesting. That I would say you're right. I think the shifting with AI is moving very quickly.
Yeah.
You hear a lot about AI. In fact, I was listening to an audiobook today, written by Mark McGrath and co-authored by another gentleman. I can't think of his name. Targeting millennials and investing, and he talks. And the book is recent, so he's talking about how quickly AI is. There was some estimated number of a very high number. I can't remember the specifics, but a lot of jobs will be lost to AI and quickly. So I guess it's important for companies to shift their focus. And what I'm wondering is, are they shifting that focus into energy because you need energy to run a lot of the AI?
Well, I mean, yeah, from what I understand, those what do they call them? Like the warehouses where they have all the data centers, right? Data centers. Apparently, they consume a ton of energy, so that'll be good for utility companies, right? Utility or whatever they're running those data centers off of. I guess I'm assuming it's electricity. Who knows? But yeah, that'll definitely drive those utility stocks to go up in the future. Um, it's hard to say, Darren. I mean, I don't really study that, I guess, macroeconomics in terms of AI replacing jobs. It's funny though, like whenever one job becomes obsolete, other ones seem to, be created, right? Um,
Yeah, I was thinking about that sector wise, is whatever that job loss was, there'll be a supportive job created somewhere else that somebody could shift into. But then
yeah.
it makes someone that, if they were trained to be in the tech industry, would probably have to, go learn something new. I just thought it was kind of interesting to hear because this book is relatively new. You should check it out. I listened to it on Spotify on audiobooks. But he's also part of the Rational Reminder group. He worked for Ben Felix and PWO Capital, and then he left. He was actually on the show for a while. I thought it was a pretty interesting listen because he's targeting millennials specifically, but there's a lot of good information in it. Something else I guess I wanted to talk about that we were talking about last month is we were talking about some sector allocation as far as a growth investor like myself is looking to diversify around the world. And we were touching on the idea that in the income space, you're focusing on different areas. They're just not necessarily around the world. Can you touch on what have you done since the last month with your portfolio since we talked?
So that's actually a good question, Darren. And I find a lot of people are hyper focused on the US, obviously, because it's always been the biggest market and performing the best. But you can see lately, the last couple of years, Canada's been outperforming, right? And a lot of, I think, Europe and some international, I guess some Asian Pacific markets are doing better as well. So maybe there is some reason to be more diversified. So what I did was Evolve came out with 3 ETFs. One of them's focused on the US, one of them's focused on Canada, and one of them's international. And of course, I had the US one, I had the Canadian one, but I didn't have the international one. Then they came out with a fund of funds. So they came out with, and they called the tickers called Easy, right? So basically what they did was they took the three of them and put them all together. So I sold all the shares I had in the Canadian one called Canny, and I put it all into Easy. So now I have the international exposure as well. So I am
Right.
looking for, I'm trying to have less single stock ETFs, the ones that are more volatile, although they do pay better, they can drop faster as well, and go more towards the funds that are more diversified, holding not only sector diversification, but global diversification as well.
Right. So that's actually one of the points I was wondering because from where I sit, I was talking in my last video about how I'm way overweighted in the States and didn't really realize it. Although I must admit, since I've done that, I realized my spreadsheet has a fault in it and it doesn't look at XEQT. So XEQT being the all-in-one fund of holding all these other funds. I didn't set the spreadsheet up to account for the different percentages of each of the funds within it. So I need to rectify that. I will try to fix that. But I do know that I was overweighted in the US, and that was because of the income funds that I had introduced, those covered calls, not realizing that I was implementing all this US exposure. Obviously, I'm working to rectify that, but that was one of the things I wanted to know. So you said it was Canny? Is that what it's
Yeah.
called?
Yeah, Canny. Canny, I think it had 10 or 11 stocks in it. So it's the Canadian market, right? So the Canadian market, you're gonna have financials, you're gonna have energy, oil, right? You're gonna have utilities, and maybe railroads. So it's just going to hold 10 or 11 of the biggest companies in Canada. So think about RBC, TD Bank, right? Like Suncor, Enbridge, utility wise, maybe Hydro One. I can't remember exactly which stocks they have, but those would be the big companies in there. Maybe I don't think I can't remember if it holds the railroads or not. I think it does. I think it has both railroads in it.
Okay, Paul,
Nice.
I just pulled it up here and I'll just go over the holdings that you were talking about with Canny. So uh Kamiko Corp is the first one that's on the list. It's 10% weighting. It looks like it's actually pretty evenly weighted. Then you've got CIBC, TD Bank, Brookfield Corp, Shopify, Bank of Montreal, Royal Bank, uh, Canadian Pacific Kansas, Enbridge, and Canadian Natural Resources. Yeah, and they're all very almost equally weighted. The last one there is 9.02, and the other ones sit around 10. So pretty close to 10%, very equal weightings. Now, it does say there's a total of 20 holdings. So we'll just change the page here. And we'll go over the other ones real quick. So,
You know what? The rest of them, Darren, are just calls. See how it says
oh
calls?
yeah, I see that.
Yeah.
So
So
we
those are
have,
just call options or positions that they hold
I see. Okay, so you have the actual holdings they have, and then the calls.
that they write. Yeah.
Interesting. Okay.
Cool,
So
eh?
that's actually what I wanted to kind of maybe have you talk a little bit about was this whole notion of, because we talked about it last time, I'm looking to diversify around the world, and this gives you some of that exposure. Now, you mentioned that there's an international one.
Yeah. So the international one, the ticker is INTY, just INTY. And so I didn't own that before, so I didn't have any exposure internationally. And then the nice thing is, Darren, for me, you and I were talking about like reducing how many holdings we have. So now instead of holding, Biggie, Canny, and Inty, you can just buy easy and you have three in one.
Right.
And
Yeah, that makes
actually, I
sense.
just I just found out that Brompton, I don't know if you've heard of Brompton. It's another Toronto-based fund provider. They decided to come out with something similar. Holds 20 stocks, and it's globally diversified. It's got US, it's got North American, Europe, and then Asia Pacific.
Okay, so you can find some of that global diversification. Yeah, so that's a subject that I thought would be kind of interesting to touch on, because that with that diversification, if, for instance, we were talking about tech and energy, one maybe not performing as well as the other, with that diversification, then it allows for one part of your portfolio to perform while the other isn't. And in my space, that's exactly what is going on. Like in an XEQT, for instance, if Canada, like you mentioned, is doing well and the United States isn't doing as well, then the fund still continues to truck along, kind of balances each other out. I know
Yeah.
that's a pretty layman's beginner look at things, but it's interesting. So I guess that's what I really want to know. Are there other funds then that you could look at to give you some more of that diversification? Have you figured any one of those ones out yet?
There are, and actually, Darren, there are all-in-one funds like XEQT that have covered calls on them. I can't remember if it's HEQL or ECQL. But anyways, there are funds, right, that are just like XEQT, except they have covered calls written on them.
So that'd be like the all in one. It'd be interesting, actually. Maybe we can do that. If first of all, I mean, the audience is watching us. If you have some ideas, throw them in the comments. And
Yeah.
maybe next video, Paul, what we'll do is we'll take a couple of funds and maybe do a little bit of a deeper dive on the next video so that we can show like some of this allocation stuff that we're talking about. I imagine there's a lot of people that watch that are fairly experienced, but there's always new people watching that might be interested if they want to go down the growth side like I am, or if they want to go down the income side. And there might be a way for us to come up with similar allocations so you get that diversity. I personally don't know all of them, but I'm interested to learn about them.
Yeah. Darren, I had a question for you because you know that I started buying XEQT as well, added that to my portfolio as my growth portion. Now, when you do your buys, right? Do you just randomly buy? Do you have a day of the week that you buy, or do you wait for a pullback?
Yeah, great question. And that touches on what I was talking about with the post that I did on Blossom. And by the way, guys, if you're new to following this series where Paul and I talk together, that's how Paul and I really got to know each other. So Paul's in Ontario and I'm way out in BC. We connected through Blossom Social. The link is in the video description below. If you want to support both our channels, there is a link. We do get a small kickback if you decide to sign up for something, but it's a great way to meet other people. So check that out. So for me, when I made this post, like I said to you, it was kind of like, well, I don't have any money left over. I'm dollar cost averaging. That's the way what I do. So every 2 weeks when I get paid, that money goes into my TFSA. My goal has been from the very start of my channel is documenting me building up my TFSA to maxing it out. And I'm older in my 50s, so I had all the room, which I think works out to about $109,000 currently. And I'm about 3/4 of the way there to maxing it out. So every 2 weeks, it's literally like whatever the allocation is that I'm low on. So right now, if you watched my last video, Canada and International are the two funds, XEF and XIC, that I'm a little shy on. If you're holding XEQT, both of those funds are actually within it. So you would get that diversification. But if you keep buying XEQT, you muddy the waters a bit. So I need to increase my Canadian International. So I don't look at the price. I don't look at dips. It's just every 2 weeks, I need to buy these, I buy them. And to explain it from my lens, simply what it means is if if I tried to time the market, so let's say today, I don't know, maybe I knew Trump was going to make some, crazy tweet again, and I knew that the price would drop. Yeah, maybe, but how am I going to know that? Up and Carr, if Carr watches this, he'll chuckle, but a lot of people that follow the evidence-based stuff will kind of lean into the fact that markets are efficient. So if I try to time that, I'm not going to do it. Everybody else knows the information either faster than me or when it happens. So I don't need to do that. I just need to keep putting money in. And I'm going to lean into the wealthy barber. You made a post about that the other day, and highly recommended. But pay yourself first and then live off the rest. And when you find the
Yeah.
balance between paying yourself first, and that doesn't mean, be broke, don't go to Mexico and, you just got back from a trip,
Yeah.
and you can still do those things. You just have to find the balance somewhere along the way. So no, I dollar cost average. It doesn't matter what the price is. I guess I'd be lying if I didn't tell you when I wake up like, for instance, I noticed Monday morning markets can take off in the first maybe half hour to an hour, and then there'll be sometimes quite a dip on Mondays. But then if you wait till the end of the day, things can significantly change where they drop down. But again, trying to time the market, you may miss out. It might actually go the other way and then you miss out. So no, I don't time it. I just put the money in. And then the other one I do is every week, going back in time, I got some financial advice from the Enriched Academy. And the advice that I got specifically for this one thing was I was doubling up mortgage payments. And the advisor was like, why don't you stick that into your registered fund? So this year I did a video on taxes, how that helps defer some of that tax off to when I retire, and I won't be paying at such a high rate. And so every week I put $350 into a spousal RRSP. So that goes to my wife. I get the tax credit. So that's basically how it works. I don't try to time the markets at all, just straight in there. Now, as I said to you, the big thing for me right now is just trying to get the balance right of that asset allocation, because that got a bit messed up, but that's okay. I can fix that.
Yeah. For XEQT, I'm doing the same every Monday, first thing in the morning. Like I have it automatically set up to buy $100 worth every week. So sometimes it doesn't settle for some reason. First thing in the morning, it's like later on in the day that it'll go through because it's fractional, right? It's a fractional share buy. But yeah, for XEQT, that's what I do. I just set it up. It happens every Monday. I don't even have to think about it. But with my other money from my dividends, from my monthly income or whatever, I get paid. I get paid almost every day of the well, I do get paid every day of the week. Weekly dividends, monthly dividends, all that stuff. I like to be in charge of what I'm going to buy and when I'm going to buy it because the market is so volatile. And out of everything that I own, there's always something that's down low, right? Like really down low that I can, buy more of at that day. And you never know, 2 weeks later, it could be up $3, $4 higher than it was the day that I bought it. So I try not to buy anything that's over what I originally paid for. I try to buy below, but maybe it's a
Right.
little bit different for income than it is for growth because yours
Well,
might tend to go up all the time.
Well, it's interesting because that's what you were talking about with ENCL is you're seeing some price appreciation, which typically is not something you'll see a ton of. Not that it doesn't exist, but if you can take advantage of that, I guess you're just rolling it into another fund and seeing the price appreciate while gathering some dividends. I want to make a couple of points. You mentioned that. So, do you have contributions that are going into XEQT, like straight into the account and then automatically invested into XEQT? Is that what you're doing? It's
No,
just
so
dividend.
yeah, yeah. So I have let's say in my RSP, and then Canadian dollars, because I have US listed funds as well. But in Canadian dollars, say I make about 12 or $1,300 a month in dividends, I allocate $100 a week of that towards XEQT. So
Okay.
I'm not
So
actually making a contribution, from other sources of income. It's just yeah,
the
yeah,
only
just
reason I was asking is that you've hit on something that's a bit of I don't know what's the right term. It's a hiccup with Wealthsimple because I assume you're using Wealthsimple.
Yeah,
So for my kids' RESP and some of my other, that's really the only one I do it. I have a regular contribution every 2 weeks, and that's to take advantage of the grants. And then I have it on auto invest. But what I noticed is what you just pointed out. I don't have to do it, but it does it really late in the day.
yeah,
So, at point number 2 is when we talked last time, we were talking about drip essentially, having it on or off. I think we had briefly discussed that. Since that video, I actually turned them off, and I did that because I realized I'm overweighted. And so if I'm overweighted, when I got drip on, it's just gonna keep adding shares. And I
yeah,
think the topic we were talking about was HHIS. That
yeah,
was the subject we were
yeah,
talking about. So I turned it off, and now all the dividends like yesterday. Well, the first week here is quite a few distributions and dividends, and I reallocated those specifically into Canada and international funds to avoid the overweighting that I was causing on my own. So you do have to pay attention. Drip's great, and automatic stuff is great, but it's not perfect.
yeah. That's right. And what I really love about this, Darren, is that I can be an income investor, but use the dividends or distributions from my income ETFs to buy XEQT, which is a growth fund, a pure growth fund. And I mean, we're only 52 years old, right? So if I pour money into that for, say, the next 20 years, and I'd like to increase it. We started, well, Sean does FEQT. We match what we do. We started with $50 a week. We made it $100 a week. Now I asked him, can we go to 150? So what we decided to do was when we get our dividends, because we typically get most of our dividends on the 6th to the 8th of the month, we'll throw in an extra $200. So $100 a week, and then once a month, an extra 200. So I'd
That's
like
a
to keep
great.
growing it.
Pardon me.
I'd like to keep growing it. I mean, my RSP, I'm not using to live off of right now, right? So I don't actually need the income. But I have so many different ETFs in there that are generating income. But instead of having to put money in from my own pocket or whatever to buy XEQT, I just roll that into it. So
Yeah, absolutely. And I think you're hitting on something I think that's important for people to think about is like we're in our early 50s and people will be thinking like if you look at some of my thumbnails and my titles, I talk about investing later in life, but the reality is you might have 10, 15, or even 20 years before you'll touch that portion of your
yeah,
portfolio because drawing down on it is significantly different, and that's actually an important planning point as you look towards retirement. So that's actually a good way to look at it. I guess that's where we get this notion of being hybrid investors in some ways, but I like that idea in the sense that you're putting some money into something that will grow over time, and as you said, you don't need the distributions per se. So I wanted to ask about now that we've talked about sort of the asset allocation and stuff. Is there a specific fund right now that you have that sort of and I think I had hinted about it last time that you think is like the strongest performer? And what I'm leaning into is you mentioned for me with my emergency fund, a fund to rely on to see some total returns and income would not have been HHIS like I chose.
yeah.
Is there a fund? And you did mention them, but I thought we should talk about it again. Are there any specific funds that you think, are strong performers, steady eddies, that kind of thing?
Yeah. So if I was, and it's funny, Darren, because I did a video on creating a cash wedge for income investors, and I called it a cash flow wedge instead of a cash wedge. And some people got really upset because I put in an ETF called HBTE, which doesn't hold Bitcoin, but it holds crypto related companies and ETFs and stuff, right? So it is pretty volatile, but it also pays pretty well. And I only allocated $2,500 to it out of 15,000. So I thought it was a real small portion. But people thought that considering this is supposed to be kind of not an emergency fund, but kind of like an emergency fund, that maybe that was just too risky. But if I was going to recommend something that was not financial advice, but something that's, like you said, a steady eddy, right? Something that you can almost bank on. HDIV, right? HDIV from Hamilton has just proven itself over time now. Now, I wonder what the managers are going to do because I think a lot of its holdings were in the financials, right? I think they had some gold, right? They had stuff that's done so well in the last year, but things don't do well forever, right? They can't continually go up and never go down. So I wonder if they're maybe rotating a little bit out of some of their maybe bank positions where they've made a lot of money and moved it into something that's down a little bit right now to try to balance out for the future. But whatever they do, they've done a great job for the last, I think, 3 or 4 years. So HDIV would be probably a safer bet than HHIS.
Okay, well then maybe for next video, that's what we'll do. And the audience, you can weigh in. We love suggestions. We often get feedback. And keep in mind, this video goes out on my channel and it goes out on Paul's, and so any of the feedback we get, we can certainly lean into. But I think maybe that's a good one that we could lean into, and maybe we could talk a little bit more in depth about XEQT. We'll go over some of the pros and cons, or some of the deeper dive, I guess you might say, about these funds on the next video. It would be interesting too to kind of keep have a list, because that was my takeaway from last time when you mentioned that, and that is the fund that you mentioned was HDIV. It'd be interesting to see if there's a way to see, what when we in the growth world, I think maybe that's what people do, is they're like, I'm looking for the widest asset allocation that will give us the not the best returns, but will be that steady eddy, I guess would be the. And so it'd be interesting to see if there are other funds that we could talk about later to sort of make a list. Now, I guess I should have prefaced this question with, none of this is financial advice. We're just two guys chit-chatting. But if you're interested in HDIV, then I would suggest go to Hamilton's website. As you
Yeah.
saw when I put up Canny up there, that's where you want to go, and that's where you want to educate yourself, read about it, learn about it. And with AI now, you can ask it all kinds of questions and then refer back to their website. So it's really important. Don't just do what we do, because that's silly. Like, it's your own money, you wanted to see it grow, so take some time to educate yourself with respect to that. So if that's the strongest performer, then like in my portfolio, I would say that VOO and VFV, and then because XEQT holds similarly, those would be the sort of steady eddy strongest performers all around.
Yeah.
For my portfolio, I do have some single stocks in there, but honestly, I couldn't tell you which one stronger or worse, because when I started, I purchased them not realizing what I was buying, and now I'm trying to figure out, should I keep them, should I get rid of them.
Yeah.
One thing I do know is that the amount of money that I have in some of these single stock positions doesn't move the needle. And even though I own Apple and I'm getting nice returns, it might not be worth holding them long term. But anyway, at the end of the day, those are the stronger ones. So now let's talk about one that might not be super strong. What would that be?
Not super strong.
Yeah.
Well, I mean, so this one is I'll say MSTE, right? I'm sure you've heard of it from Harvest, right? It holds MicroStrategy or Strategy now, MSTR. And it's not that it's not super strong, it's just that it's super volatile, right? And when you're buying a single stock ETF, or even a single stock, like you own a few, I think you used to own Tesla, or you still own it,
I still have my Tesla position, yeah.
right? Tesla is a fantastic company, right? And they're creating all these new technologies and AI and robots and everything. But that share price could go to $400, $500, $600, and it could go back down to $100, right? In a matter of days, weeks, right? So when it's down to $100, it doesn't necessarily mean that it's a bad company, right? Or a bad ETF. It's just that's the way it is because it's that volatile. That's hence the reason why most people should just invest in the S&P 500, invest in the NASDAQ, invest in maybe, what is it, the TSX 60 in Canada. And then you don't have to worry about the volatility from one stock.
Yeah, that actually leans a little bit of sidestep, but like, what is your risk tolerance really like? And when you
Yes.
own stuff like that, it'll really test your patience. Can you go to sleep at night knowing that those funds might not be performing well? What I can say for my Tesla position is you're right. It swings massively. Anybody that owns it will know that. They usually have, a lot of people will set a price when they want to buy it. I guess that's similar to what you've been mentioning with some of your funds. Um, I haven't touched the stuff. I've got money that's sitting in it because I've been focusing on the asset allocation part. And though Tesla's in XEQT, VOO, VFV, so
Yeah.
I own a lot of it. Just in, I guess, fractions might be the way to put it. And
Yeah.
so having the single stock exposure in my portfolio, probably not the best. But anyway, time will tell. I can't deal with everything all at once. Um, but yeah, that volatility can, if you're paying attention to it every day, it's hard pill to swallow.
Yeah. But you know what, Darren? Like, if you like a company like Tesla and you're willing to sit on it for a long time, and when it drops, maybe it drops 10, 20, 30%, you're willing to buy more. When it recovers, you're going to make more money than you will just holding it in like a VU or what have you. But you really have to be willing to hold. You know what? I'll give you an example. I taught my son, who's now 21 years old, how to invest, and I opened up his TFSA at 18 years old. I got him into some covered call ETFs. We swapped some out here and there. And, I tried to get him making the most money he could on a monthly basis. Then I started him on XEQT and FEQT. Well, 2 years ago, he decided to buy a gold stock. Some buddies at school were talking about it, and he put $1,000. Sorry, he bought 1,000 shares. He bought 1,000 shares of a gold stock at just under $1 a share. Today he texted me. It was up $4 just today alone. It broke $10 a share. It's over
Wow.
$10 a share. So he's up thousands of percents. You know what I mean?
Yeah.
And
Amazing.
but you have to have the risk tolerance, because that gold stock, it swung up to like $4, back down to 2, up to 6, back down to 4, up to 8. And every time it would hit a new high, I'd be like, why don't you sell some? And he's like, nope, I'm not selling, you know. But look at now he's up over $10 a share, and started at like 87 cents.
I think that's maybe why some people kind of equate some of this stuff to gambling, because you get like a rush from it, right? Even just sitting here listening to this, it's exhilarating to think that that can happen. It's like winning the lottery, but at the
Yeah.
same time, and for me, and not to say that I don't do that, I do. I love the fact that I could invest in something and see it go up, like Tesla, for instance. But what I've realized is that you got to make sure it's money you're willing to lose. That's
That's
the
right.
key. Is like you have to,
Yeah.
like, I put some money into a company, and I literally thought to myself, I might as well just burn it, because if the company goes out of business, I don't have that anymore. And
Yeah.
you've experienced that. I think you had said in previous videos, have you not, that you'd lost some
Oh, I
money?
have. Yeah. Oh, yeah. I remember when, a few years ago, I think it was 2021 or 2022, when there was a lot of YouTubers talking about penny stocks, these small, like, what was that chef's, what was the chef's one? Can't remember now. There was Drone. I don't know if you remember Drone. The ticker was FLT. They were talking about how all your Amazon packages would get delivered by drones, right?
Right.
And, at one point it skyrocketed. It went up from like 50 cents to $2.50. And, I knew a lot of people that had it and could have made good money. And it was like, do we sell or do we keep holding? It's like, well, what if it goes to $5 or $10? You're going to kick yourself because you sold. And now it's back down to like 60 cents. But
Right.
yeah. So I at the time it was like, you know what? I'll just put $300 into this penny stock and see how it does. If I lose $300, big deal, right? I'll put 500 into this one. And Darren, like 9 times out of 10, yeah, they went to nothing. So
Yeah.
I don't even try anymore.
It's I think I was thinking about my Bitcoin position, because it's like $450 right now. Very speculative. The more,
Yeah.
I'm eventually going to do some videos on it when I do a deep dive, but I often do my research when I'm walking the dog in the morning. I have just me and the dog, and I sit back and I think, like, what would be some good video topics, and that's definitely one I want to do a deeper dive. But I'm thinking to myself, like, all I have is $450 of this stuff. It's really a pittance at the end of the day, but it's
Yeah.
so speculative that I don't want to lock up a whole bunch of money in it because I haven't researched it enough. But more importantly, is it's very volatile and it really has no intrinsic value like a company, right? Like I know that Coke will always sell stuff and they'll have a dividend and their price will go up. I don't know about Bitcoin. Like it sounds
Yeah.
like Bitcoin reacted quite well to the peace between the well, we won't call it peace, but like them opening the Strait of Hamas. So
Yeah.
that was kind of interesting. Like what triggered that? I don't know. I don't know enough about it, but obviously the speculative nature of it, maybe that's what it was. Like is somehow tied to oil in some way. I guess I don't know.
I don't know, but I think if you do believe in Bitcoin, right, and you want to invest in it, now's probably not a bad time to be doing that, right? Because it's down right now. It doesn't look so appealing. You know what I mean? It's not flashy anymore, but now might be the time to be buying it. I think in the last month or so, there's been periods where it hits like $63,000. Then today it was back up to $72,000. I've had people comment on my videos, Bitcoin's going to 20,000. It might, I don't know. Maybe they know something we don't know. It could go to 20,000. It could go to zero, right? We don't know. But
Yeah.
you're buying it, so you must believe that at some point in time it's going to recover and, say go back to 100 grand. You're better off putting more money into it now than waiting until it hits 100 grand and then start buying more because of FOMO.
Oh, absolutely. I'm definitely not going to follow the FOMO, which is true. And when some of the videos I've done, I put up some screenshots of the performance of Bitcoin, and there's huge swings. There's been a couple of big ones. This is the third one in a row, if you will. And we're definitely at the sort of on the way down, although there was a bit of a improvement in it, but you don't know when that is. So that right
Yeah.
now it's just dollar cost averaging. And I'm not gonna lie, like I was out walking the dog and I was thinking, should I put a little bit more in there? But at the same time, that's not what my plan is. And you know what? It's just thinking like planning wise, we have a lot of bills that come up in the future, like your insurance and things, that you want to plan for. So don't get too crazy sticking money in the markets and all of a sudden wonder where you're going to get your money for your property tax and stuff. So on the
Yeah.
side, I'm still doing those things, and whatever's left is what I would do that with.
Yeah.
And we're just in a bit of a transition. My tax return came back in. I invested all of that, and now I'm setting up for the other bills that we have coming up. So if there is a bit of extra cash left over, it might go into that. Who knows?
Yeah. Well, I think you said, what do you do, like $25 a week?
Right now, it's $25 a week. Yeah.
I mean, even if you did $50 a week, you probably wouldn't notice it, right? It's not that much more, but yeah, you're right, Darren. Like, I mean, I think a lot of people, when I did my cash flow wedge video, they thought that, I'm walking this line of being broke. You know what I mean? Like, I don't have any spare money and I shouldn't be taking any kind of risks. But, my wife and I, we set money aside for vacations. She's great at saving. So I know she's got emergency funds. She doesn't tell me how much she has, but I know she's got emergency funds set aside. And, so we do that. Plus, I saved up $15,000 just to start that cash flow wedge. I thought I did really well, So I mean, we squirrel away money. We're not like two paychecks away from being broke.
Yeah. And for me, like that emergency fund experiment that I did, initially that was the emergency fund, but subsequent to that, seeing how that performed, I realized that you do need to have some extra cash sitting on the side. So that's basically why I'm not changing the plan right now. And
Yeah,
once I get everything sorted out, then we'll see about putting some more money aside. And like you said, $50 into it every week, that's $200 a month. No, I'm not really going to notice that per se. But for now, I want to stick to the plan I have until I get all the other stuff stabilized first, and then we'll kick that into overdrive a little bit more. All right, Paul, I think we're up against some time. We
yeah,
said that we want to make these slightly shorter for the audience, but I will say to the audience that I hope you enjoy these conversations between Paul and I. I'm always looking for suggestions, and whenever Paul sees the comments as well, we kind of chit chat before the end of the month. So if you got something you're interested in hearing us talk about, maybe about our personal portfolios or something that maybe we know that you think we could expand on, like we said about some of the ETFs, please drop it in the comments. We really appreciate that. Don't forget to like and subscribe to both of our channels. Links are in the video description. And if you want to see more of this content, you should watch this playlist right here.